Look, I have to be honest with you right off the bat. When I saw the stack of documents for today's deep dive, my first instinct wasn't excitement, it was actually anxiety.
Well, really?
Yeah, I mean, I actually looked over my shoulder while I was reading them. I felt like I needed to put on sunglasses, lower the blinds, maybe switch to a burner phone.
A burner phone?
Seriously, we are talking about some heavy-hitting financial strategies today. The kind of stuff that usually happens behind closed doors in, mahogany-paneled offices in Zurich or Singapore. It feels risky.
I get that.
It feels like we are walking a very fine line here.
Well, it feels that way because that is exactly how the system is designed to make you feel.
What do you mean by that?
The system is engineered to make the average person feel like anything outside of a standard savings account, a 401k, or a basic brokerage account is dangerous, that it's illicit or shady.
Right.
But I want to stop you right there. We need to completely reframe this entire conversation before we even open the first file in this briefing.
See, that is where I get nervous. When you say reframe, I hear rationalize.
It's not rationalizing.
But we're looking at offshore trusts. We're talking about moving physical gold to islands I literally cannot find on a map without zooming in 3 times on Google.
The Cook Islands aren't that hard to find.
To the average retail investor like me, and probably a lot of people listening to us right now, offshore equals illegal. It sounds like hiding money from the government. And frankly, I do not want the IRS knocking on my door. I am highly skeptical of this whole thing. Why are we even talking about this if it paints a massive target on our backs?
Because the target is already on your back.
How so?
That is the fundamental misunderstanding here. You think that by keeping your head down, by keeping your assets in your own personal name, and following the standard financial advice, that you are safe.
I am safe. I pay my taxes.
You aren't safe. And we are not here to talk about hiding income. Let me be crystal clear right out of the gate for you and everyone listening. Tax evasion is illegal.
Yes, exactly.
Hiding income to avoid paying income tax is a felony. We are not discussing that today. What we were discussing in this briefing is survival.
Survival, that's a strong word.
It is the right word. We are discussing the stark difference between the middle-class mindset of owning things and the billionaire mindset of controlling things. This is an intelligence briefing on the Offshore Dynasty Trust.
Okay.
And the mission isn't to hide. The mission is to protect your life's work from the single most devastating financial event you will ever face.
Yeah.
The death tax.
The death tax. Okay, let's unpack this right now. You were talking about the estate tax, right?
Yeah.
But isn't that just for the ultra rich? I mean, I am doing okay, and maybe some of our listeners are doing very well. We've got small business owners, doctors, professionals tuning in. But are we really in the danger zone here? I thought the tax exemptions were massive right now.
You might not be in the danger zone today, but the laws are changing. There is a ticking clock that we urgently need to talk about.
Ticking clock.
Yes. But beyond the tax itself, there is a fundamental philosophy we need to get into first. The core conflict we are exploring today is this. The middle class spends their entire lives trying to put their name on everything.
Well, yeah, because it's a mark of success.
Exactly. You want your name on the deed to the house. You want your name on the car title. You want your name on the bank account.
Naturally.
You definitely want your name on the safe deposit box where you keep your physical gold coins. You think ownership equals security.
I mean, if I own it, I control it. It is mine. If I have physical gold sitting in a heavy safe bolted to my basement floor, that is the ultimate security, isn't it?
No.
I can touch it, I can see it, no bank can freeze it.
And that is exactly where the trap lies. The smart money, and by that I am talking about the Rockefellers, the Vanderbilts, the modern billionaires, they follow a completely different maxim.
Which is?
Own nothing, control everything.
Own nothing.
Because if you own it, if your actual personal name is on the legal title, it can be taken.
Taken by who?
By everyone.
Come on.
By creditors, by lawsuits, by a judge in a divorce court, and most efficiently, by the United States government when you die. We are going to decode the Offshore Dynasty Trust today. Not as a way to cheat the system,
Okay.
but as a legal architecture. A fortress, really. A fortress that is used to protect physical assets like gold from those exact predators.
All right, you are the expert here. You are playing the role of the elite estate planning attorney today, decoding the loopholes. I'm just the guy who is nervous about getting audited.
I know.
So walk me through this. You said that putting my name on my assets, my house, my gold stack, paints a target on my back. I call this the red target concept. Why is personal ownership so dangerous in the real world?
Think about the environment we live in today. We live in the most litigious society in the history of the world.
True.
In the United States alone, there is a lawsuit filed every few seconds. If you have assets in your name, they are visible, they are public record, and more importantly, they are attachable.
Attachable meaning someone can grab them.
Exactly. Let's look at the three main predators that are constantly hunting for assets held in your personal name. Number one is creditors and lawsuits.
Right. So if I get into a bad car accident, or someone trips on the icy sidewalk outside my house.
Yes. Or you get sued for something related to your business. Maybe your teenager is driving your car and causes a massive multi-car pileup. Or a disgruntled employee sues you for wrongful termination.
Okay, everyday risks.
If you are sued and you lose, the judge issues a judgment against you. If your assets, your bank accounts, your brokerage accounts, your second home, and especially that stack of gold bars in your basement safe are in your name, they are legally seizable.
They can just take the gold.
The plaintiff can get a court order to come and take them to satisfy the judgment. You could literally lose your entire life savings because of one bad afternoon or one honest mistake.
That is a terrifying thought. But look, I have insurance. Doesn't my umbrella policy cover this kind of stuff? That's why I pay premiums.
Insurance has limits. And let's be honest, insurance companies are heavily invested in the business of not paying out claims.
Fair point.
They have armies of corporate lawyers whose sole job is to find an exclusion in your policy. They will say, oh, that was an intentional tort, not covered. Oh, that incident happened on commercial property, not covered.
And then I'm on the hook.
Exactly. If the judgment exceeds your coverage or the claim is denied, they come straight for your personal assets. But let's move to predator number two, probate court.
Probate? I've heard horror stories about this.
This is one people really do not think about until it is way too late. When you die, if your assets are in your personal name, they do not just magically teleport into your children's bank accounts.
They get frozen.
They get completely frozen. They get dragged into a lengthy legal process called probate.
Which is a public process, right?
It is entirely public. Anyone with a basic internet connection can look up exactly what you owned, who you owed money to, and who was getting what.
That sounds like a privacy nightmare.
It is a massive privacy nightmare. It attracts scammers and long-lost relatives who target your heirs the moment you pass away. Plus, it is incredibly expensive.
Because the lawyers get involved.
The lawyers take a huge chunk. The court takes a chunk in fees. And it is incredibly slow. Your family could be completely locked out of that wealth for months, sometimes even years, while the court slowly sorts it all out.
Okay, so that is the administrative nightmare. Lawsuits and probate. But you mentioned the big one earlier, the death tax.
The IRS predator number three. And this is by far the biggest threat to generational wealth. The federal estate tax.
Walk me through it.
Currently, the federal government says that if you die with more than a certain amount of wealth, they have the legal right to confiscate 40% of everything above that line.
40%. That is a staggering number when you say it out loud.
It is.
I mean, imagine working your whole entire life. You pay income tax on every single dollar you earned. You pay sales tax on every dollar you spent. You pay property tax every single year just to keep your home. And then at the very end of it all, the government comes in and scoops nearly half of whatever's left.
It is effectively a forced confiscation of your life's work. And here is where the intelligence briefing aspect of this deep dive becomes absolutely critical for the listener.
Okay, lay it on me.
Most people hear 40% and think, oh, the exemption is super high right now. I do not have $20 million in the bank, so I am totally safe from this.
Right, because the exemption, the amount you can pass on tax-free is historically high right now. I remember it was doubled a few years ago under the Tax Cuts and Jobs Act, I think.
That is correct.
So a lot of people, including myself, are sitting back thinking, I am good. I am too small of a fish to be taxed like a billionaire.
And that right there is the trap. Because there is a sunset clause built into that law.
A sunset clause? You mean it expires?
Yes. The current tax law, that specific Tax Cuts and Jobs Act that doubled those exemptions, is legally set to expire. It sunsets on January 1st, 2026.
Wait, 2026? That is right around the corner.
It is imminent.
Yeah.
On that exact date, if Congress does nothing, and if we look at the historical gridlock in Washington, betting on them to do nothing is usually a very safe bet, the exemption amount gets slashed in half.
In half.
It automatically reverts to the 2017 levels, simply adjusted for inflation.
So suddenly, millions of people who thought they were completely safe Small business owners, people with a nice house and a solid retirement account, people who have been stacking physical gold for 30 years, they're suddenly caught right in the dragnet.
Precisely. We need to look at the raw math here, because slashed in half sounds a bit abstract until you actually see the numbers on a balance sheet.
Let's do the math.
Right now, the exemption is roughly $13.6 million per person. So, a married couple can shield about $27 million from the estate tax.
Right, 27 million is a very high ceiling. You feel pretty safe playing under that roof.
But watch what happens on January 1st, 2026. The ball drops in Times Square, the champagne is poured, and the Tax Cuts and Jobs Act officially expires. That number reverts. Projections put it around maybe $7 million per person. Let's call it $14 million for a married couple.
Okay, so the safe zone shrinks drastically.
It does not just shrink. It completely collapses for the upper middle class. Let's take a specific, highly realistic example.
Okay.
Say you are a successful general contractor or a doctor. You have built a private business worth about $10 million, which, by the way, isn't that hard if you own the commercial real estate, the heavy equipment, and the intellectual property.
Sure, 10 million business value.
You also have a primary home in a good neighborhood worth $2 million.
Yeah.
You have a vacation rental property worth $2 million, and you have a solid, well-managed retirement portfolio of $4 million.
So total net worth is, what, 18 million?
You are sitting at exactly an $18 million total net worth.
Okay, so on December 31st, 2025, if I die, I am totally fine. I am well under the $27 million limit for a couple. My estate tax bill to the government is exactly zero.
Correct. Your family gets everything. But if you die 2 days later, on January 2nd, 2026, the limit is now roughly $14 million.
Wow.
You still have $18 million in assets. That leaves $4 million completely exposed above the new limit. The IRS hits that specific $4 million with a 40% tax rate.
That is, let me do the math. 40% of $4 million. That is a $1.6 million tax bill due immediately.
Purely because the calendar flipped.
Just because of the date I died.
Purely because of the sunset clause.
Right.
And remember, the death tax creates an immediate liquidity crisis. The IRS does not want 40% of your business equity.
Right. They don't want partial ownership of a contracting firm.
They do not want 40% of your vacation house in Florida. They want a check. They want cash.
So my grieving kids have to somehow come up with $1.6 million in cold hard cash. How long do they have?
Typically 9 months.
9 months.
Exactly. And if your wealth is mostly illiquid, say, it is all tied up in that business or that real estate, they have to conduct a literal fire sale.
Oh, man.
They might have to sell the legacy family business to a private equity firm for pennies on the dollar just to generate the cash to pay the treasury. This is exactly how generational family legacies are dismantled overnight. It is not just a tax. It is a forced liquidation event.
Wow. Volunteering for wealth confiscation. That is a really heavy concept. Okay, so we have firmly established the danger here. The red target is very real. Personal ownership exposes us to lawsuits, public probate, and this looming 40% tax hike in 2026.
It does.
But now I have to put my skeptic hat back on for a second.
Go ahead.
Because when you start talking about moving money to an island to fix this tax problem, my brain immediately goes back to those Hollywood movies. Guys in sharp suits laundering drug money through shell companies. How is setting up an offshore trust not just straight up tax evasion?
I actually love that you are pushing hard on this, because it is the single most important distinction we have to make today. We need to define our terms forensically.
Please do.
There is a massive, impenetrable legal wall between tax evasion and tax avoidance.
Okay, draw that line for me. Where is the wall?
Tax evasion is hiding things. It is lying to the government. It is earning income. Say you sell a business or you collect a massive salary and you simply do not report it to the IRS.
Right.
You stuff physical cash in a mattress or you hide it in a secret numbered Swiss bank account so you do not pay your income tax. That is a federal felony. You will go to federal prison. Do not do that. Ever.
Got it. Evasion equals jail time. Crystal clear.
Tax avoidance, on the other hand, or what we prefer to call tax efficiency, is utilizing the exact rules the government wrote to pay the absolute legal minimum required by law.
Using their own rule book against them?
Exactly. It is structuring your assets proactively so that a taxable event is simply not triggered in the first place. The strategy we are discussing today, the Offshore Dynasty Trust, is primarily focused on the transfer tax, which is the estate tax. It is absolutely not about hiding current income.
Okay, so we are not hiding the gold from the IRS in terms of saying, hey, I bought this gold and I am keeping it a secret from you. We are fundamentally changing who actually owns the gold.
That is the secret.
Yeah.
When you move assets into a properly structured, irrevocable trust, you are changing the legal title. You, the individual breathing human being, no longer own the gold. The trust owns the gold.
And since I do not personally own it,
Since you do not own it, it is categorically not part of your taxable estate when you die. The government cannot tax you on property you do not legally own.
that makes logical sense.
Think of it this way. If I borrow your car and I die in a car crash, the government does not tax my estate for the value of your car.
Because it's my car, not yours.
Exactly. It is the exact same legal principle. The trust is a completely separate legal person under the law. It lives on independently. You have successfully removed the asset from the federal tax system legally.
But the IRS still knows about it, right?
Yes. You report it. The IRS knows it is there. There is full 100% transparency and disclosure. But because of the specific legal structure, the tax liability drops to absolute zero.
That is a crucial distinction for the listener. We are talking about reporting everything, filing all the correct forms, putting it in the sunlight, but structuring the architecture so the final bill is zero. That sounds a whole lot better than hiding in the shadows.
It is the difference between being a reckless criminal and being a sophisticated strategist. Look at it like driving a car. Speeding 100 miles an hour down the highway to get to your destination faster is illegal. That is evasion.
Right.
Taking a legal shortcut through a side street that cuts 20 minutes off your trip because you studied the map, that is smart. That is avoidance.
Okay, strategist. Let's talk about the long game then. You mentioned Dynasty Wealth earlier. When I hear that phrase, I immediately think of the Vanderbilts, the Rockefellers, the Rothschilds, these elite families that just seem to stay rich forever, generation after generation.
Yes.
How does this specific trust help with that? Because usually normal wealth gets diluted over time, right? The grandkids spend it or it gets split up too many times.
It does get diluted. And the biggest diluter of all isn't bad spending habits. It is the tax system itself. I want you to vividly visualize traditional family inheritance as a relay race.
A relay race. Okay, I'm picturing a track.
Imagine an Olympic track.
Yeah.
You are the first runner. You have the baton in your hand. The baton represents your accumulated wealth, your physical gold stack, your business equity, your liquid assets.
Got the baton.
You run your lap. That lap is your entire life. You work hard, you run fast. You finally get to the end of your lap, and you have to hand the baton to your son for his lap.
Okay, I reach out and hand it off.
But standing right in the middle of the exchange zone is the IRS. And before your son can firmly grab the baton, the IRS takes a hacksaw and violently cuts off 40% of it.
Ouch. So he starts his very first lap with a significantly smaller baton.
Right. Now he runs his lab. He does his best. Maybe he invests well and grows it a little bit. He gets to the end of his life and he goes to hand it to your granddaughter. Guess who is eagerly waiting in the exchange zone again?
The IRS with the hacksaw. Again.
Another 40% cut. And by the way, there is also something called the GSTT, the Generation Skipping Transfer Tax. If you try to be clever and skip a generation directly to avoid the first cut.
They really thought of everything, didn't they?
They absolutely did. But just sticking to the basic estate tax mechanics, let's run the math on 3 generations of a family. You start with $10 million in the baton.
Okay, $10 million. Solid start.
You die. The tax takes 40%, assuming, for simplicity's sake, that we are purely talking about the amount over the exemption limit. Your son gets $6 million.
Down $4 million already.
He runs his lap, lives a good life, and dies. The tax takes 40% of that $6 million. That is another $2.4 million gone to the Treasury. Your granddaughter only gets $3.6 million.
Wait, we have lost almost 2/3 of the total wealth in just 2 simple handoffs.
Exactly. She runs her lap and dies, another 40% cut. By the time it actually hits the great-grandkids, the magnificent baton is basically a toothpick. The wealth is completely decimated. This is exactly why you see so many fortunes utterly disappear by the 3rd generation. There's a saying, shirt sleeves to shirt sleeves in 3 generations.
I always thought that was just because the 3rd generation was lazy and bought too many sports cars. I didn't realize it was the structural erosion of the tax code.
It is mathematical erosion. Now, compare that grim reality to the Dynasty Trust, the expert's fix. The Dynasty Trust fundamentally changes the rules of the race. It removes the handoff entirely from the equation.
How do you remove the handoff? People still physically die. You can't outlive biology.
People die. But the trust does not die. The trust is a legal entity that lives in perpetuity. It contains what we call an Evergreen Clause.
Evergreen. Like a pine tree that stays green all winter long.
Precisely. It means the trust legally lasts forever. Or, depending on the specific jurisdiction you choose, It can last for hundreds of years. So here's how the mechanics work in practice. You put the physical gold in the trust.
Okay.
The trust officially owns the gold. You are simply listed as the primary beneficiary. You live your life, you enjoy the benefits, and then you die.
Okay, my lab's over, I'm dead.
But the gold does not move. The legal title of the gold does not change. The trust still completely owns the gold. The IRS looks at the trust and says, well, the trust didn't die today, so we have no legal basis to tax it.
So there is no 40% cut at all?
Zero. No taxable event occurred. The only thing that legally changes is the name written on the beneficiary line in the internal trust document. It simply updates from father to son.
Just a paperwork update.
Exactly. The gold just peacefully sits in the vault. The son enjoyed the benefits of the trust during his life, then the son dies. The beneficiary line automatically updates to granddaughter. The gold still sits in the vault. It compounds.
So it just keeps growing untouched?
It compounds for 100 years or more without ever once triggering an inheritance tax event. That initial $10 million, instead of shrinking down to $2 million, might mathematically grow to $50 million or $100 million because you aren't paying that massive 40% toll every 30 years.
That is, wow. That is incredibly powerful.
That is exactly how you get Rothschild or Vanderbilt levels of wealth preservation.
It's like riding a hoverboard over the track instead of running a relay race. You just keep gliding above the hurdles. But here's the very next hurdle for me, personally. You keep emphasizing the word offshore. And specifically, the briefing documents mention the Cook Islands a lot. Now, if I want to set up a strong trust, why can't I just go to a high-end lawyer right here in my city? Why can't I set this up in Delaware, Nevada, or South Dakota? I know those specific states market themselves as having amazing privacy and trust laws.
They do.
So why do I have to fly my legal structure to the middle of the South Pacific Ocean?
That is the million-dollar question. And to be fair, for many people with moderate wealth, a domestic asset protection trust in places like Nevada, South Dakota, or Delaware is a very good start. But we are talking about the deep dive level of protection here today. We're talking about rendering yourself financially bulletproof against highly motivated predators.
What is fundamentally wrong with a Nevada trust?
The fatal flaw is judicial overreach.
Explain that.
Let's say you properly set up a Nevada trust. 5 years later, you get sued in California. The California state judge looks at the case and says, I order you to turn over those trust assets to the plaintiff.
I say, I can't, Your Honor. They are locked up in a Nevada trust. Read the law.
Right. But the California judge says, I really don't care about Nevada law. We are all part of the United States of America. Under the full faith and credit clause of the U.S. Constitution, the state of Nevada is constitutionally obligated to respect and enforce my California judgment.
Ah, I remember that from civics class. So
Yeah.
because it is all under the same federal umbrella, the individual states essentially have to play nice with each other's courts eventually.
Eventually, yes. And a federal bankruptcy judge. They can pierce almost any domestic trust structure if they try hard enough. They can formally order the U.S.-based trustee to hand over the gold.
And the trustee has to do it.
If the trustee is located within the U.S., they have to comply with a federal judge. If they refuse, the judge throws them in federal prison for contempt of court.
Okay, so the domestic walls have serious structural cracks when the pressure gets high enough.
Exactly. They are cracking under modern judicial pressure. But when you move the structure to the Cook Islands, you aren't just changing state lines. You are changing sovereign nations.
A whole different rule book.
You are actively operating under a completely foreign legal system that was literally written from the ground up to look U.S. judges in the eye and proudly say no.
Hold on. I really need to pump the brakes right here. You are making this sound like some kind of legal magic wand. Just go to the Cook Islands and the laws of physics don't apply to you anymore.
It's not magic, it's jurisdictional strategy.
But we live in the real world. If a U.S. federal judge looks down from the bench and tells me to bring money back to the states, and I stand there and say, sorry, Judge, the Cook Islands said no.
Am I not going to be held in contempt? Am I not going straight to a jail cell?
That is the single most important, most frequently asked question in the entire field of asset protection. And the answer relies entirely on a legal doctrine called impossibility of performance. Impossibility of performance, that sounds like a very specific legal defense.
It is a phenomenal defense. Think of it this way. If a judge legally orders you to flap your arms and fly unassisted to the moon, you cannot be held in contempt of court for failing to do it.
Because it is literally physically impossible.
Exactly. You can't be punished for not doing the impossible.
Okay, but picking up a phone and repatriating money from an island isn't flying to the moon.
Legally speaking, under this specific trust structure, it actually is. Remember what we discussed earlier? You are not the trustee. You do not hold legal title to the gold.
Right.
When the U.S. judge orders you to bring the money back, you say, "Yes, Your Honor, I will try." You then send an official request to the Cook Islands trustee asking for the funds to satisfy the judgment.
And what do they say?
They look at the request and they say no.
Just no.
It is a statutory prohibition under their laws. They are legally barred from complying with a foreign court order that actively harms the trust's beneficiary. So you take that formal denial letter, you go back to the U.S. judge and you say, "Your Honor, I asked them. I pleaded with them. They explicitly refused. I physically and legally cannot comply with your order."
Wow. Has this actually worked in court?
There's a very famous legal case, the Anderson case, where this exact defense was tested at the highest levels. The entire legal debate was simply this: is the impossibility self-created?
Well, yeah. You created the trust. It seems obviously self-created.
And that is exactly where the timeline matters more than anything else. If you get into a car crash today and you quickly set this up tomorrow to hide your assets, you are in deep trouble.
That makes sense.
That is contempt of court. That's called a fraudulent transfer. But if you prudently set this trust up years ago, when the seas were perfectly calm and you had no pending lawsuits, the courts have generally found that you cannot be jailed for the independent refusal of a third-party foreign trustee to comply, provided the structure was established correctly long before the storm hit.
So timing is absolutely everything here. You have to build the roof before it starts raining.
Timing is everything. And let's look closely at the hurdles facing a creditor in the Cook Islands themselves. If a creditor really wants your money, they have to navigate what we call the moat.
The moat.
To even attempt to pierce the trust, the creditor has to physically fly down to the South Pacific. They have to hire a local Cook Islands attorney.
Okay, that sounds expensive.
And here's a fun fact. All the top-tier local attorneys are usually already conflicted out of taking the case because they regularly do contract work for the big trust companies.
Oh, of course they are. That is brilliant.
Then the creditor has to file a brand new, wildly expensive lawsuit in the Cook Islands judicial system. They cannot just bring their aggressive New York lawyers into the courtroom. They have to use local counsel. And here is the absolute kicker: the burden of proof.
Right. In the U.S., for a standard civil lawsuit, it is usually preponderance of the evidence, right? Like, if the jury is 51% sure you did it, you lose.
Correct. Just barely more likely than not.
Right.
In the Cook Islands, to pierce an established trust, the creditor has to mathematically prove beyond a reasonable doubt that the trust was set up specifically to defraud that one specific creditor.
Beyond a reasonable doubt. Wait, that is the standard for a criminal murder trial in the U.S.?
Yes, it is. They actively apply the incredibly strict criminal standard of proof to a standard civil financial case. It is an impossibly high legal bar to clear. And on top of all that, there is a very short, aggressive statute of limitations, usually just 1 or 2 years from the time the trust was funded.
So the clock runs out fast.
Basically, the legal wall is built so high and the financial moat is dug so wide that highly aggressive creditors look at the situation, do the math, and say, it is simply not worth the capital.
So it forces a cheap settlement instead.
Or total capitulation. They just walk away entirely. Because they know for a fact they will spend millions of dollars in upfront legal fees, waste years of their life, and they will almost certainly lose the case. That is exactly why we call it the ultimate fortress.
Okay, I am genuinely starting to see the profound appeal here. It is not just about hiding the money in a hall. It is about making yourself so legally prickly and expensive that nobody even wants to try and touch you. But let's get extremely practical for a minute. I am trying to visualize myself going through the motions to set this up. Do I have to literally carry metal suitcases full of gold bullion through airport security to get it to the island? Who are the actual people involved in this machinery? Let's carefully break down the anatomy of the structure.
First rule: do not ever carry suitcases of gold through an international airport. That is exactly how you end up in a windowless holding cell answering uncomfortable questions.
Noted. No suitcases.
We need to operationalize this properly and cleanly. There are 3 key roles in what we call the triad of power for an offshore trust.
Okay, grab a pen. Role number 1.
Role number 1 is the settler. That is you, the listener, the client. You are the individual actively creating the trust document and officially funding it. You provide the initial assets.
Simple enough. I bring the money. Role number 2.
The trustee. This role is absolutely crucial. This is not your brother-in-law who means well. This is not your best friend from college. This is a highly vetted, fully licensed, strictly regulated professional trust company, physically located down in the Cook Islands. They are subject to intense local government oversight. They are seasoned professionals.
Okay, I hear you, but that genuinely scares me. I am voluntarily handing over legal title of my hard-earned physical gold to some faceless company on a tiny island 5,000 miles away. What if they just run off with it? What if the manager makes a terrible investment decision and blows the fund?
It's a highly valid fear. It's the primary reason people hesitate, and that is exactly why we legally engineer rule number 3, the protector.
The protector. That honestly sounds like a bodyguard in a spy movie.
In a strict legal sense, they are your bodyguard. The protector is a highly trusted third party. Usually it is your personal attorney right here in the U.S. or a highly specialized financial advisor.
And what do they do?
They absolutely do not own the assets. They do not hold the assets. They can't spend the money. But they have one incredible legal superpower written into the trust document.
What is the superpower?
They can fire the trustee.
Ah, it's the "you're fired" button.
Exactly. If the Cook Islands trustee suddenly becomes unresponsive to emails, or if their administrative fees mysteriously get too high, or honestly, if you just don't like their attitude, the protector can literally snap their fingers.
Just like that.
Just like that. They draft a one-page document, formally fire the Cook Islands trustee, and immediately hire a brand new trustee in Nevis or Belize or Switzerland. The trust company knows this button exists.
So it keeps them in line.
It absolutely keeps them honest. They are on their absolute best behavior at all times because they serve strictly at the pleasure of your protector.
Okay, so we have the settler, which is me. We have the trustee, which acts as the fortress. And we have the protector acting as the watchdog with a loaded gun.
Perfect summary.
Now, how does the actual physical money flow through this triad? Say I have cash sitting in my local bank account or gold stacked in my home safe. How does it smoothly get from point A into the trust at point B?
We employ a highly effective structure called triangulation.
Triangulation.
We intentionally separate the legal ownership, the operational control, and the physical location of the assets. Let's conceptually draw this out on a napkin. Imagine a large triangle.
Okay, drawing a triangle in my head.
At the very top point of the triangle, sitting safely in the South Pacific, is the foreign trust.
The trust is at the top. Got it.
The trust is the silent legal owner, but it doesn't hold the gold directly. Instead, it fully owns the membership certificates of an LLC. That LLC is located at the bottom left corner of our triangle. Let's say, for example, it is a Wyoming LLC.
What? Wyoming specifically? Why not California?
Because Wyoming has incredibly strong statutory privacy laws for LLCs. They simply do not list the individual members or managers on the public state website. So looking from the outside in, nobody easily knows who actually owns this specific LLC.
It's a black box.
Exactly. Now, inside that Wyoming LLC, you open a standard business bank account.
And I assume I am the acting manager of this new LLC.
Correct. You are the appointed manager. This is the control corner of the triangle. You personally hold the physical debit card. You possess the checkbook.
Okay.
You can log in and buy gold bullion. You can buy index funds. You can actively trade crypto. You do not need to call the Cook Islands at 3 in the morning just to authorize buying a cup of coffee or a gold bar.
So day to day, it feels exactly like my normal company. It feels like my money.
Exactly. The friction is zero. But here is the magnificent magic trick. Let's say a massive lawsuit suddenly hits that control corner. A highly aggressive creditor attacks you personally.
Okay, I'm under attack.
They do some deep digging. They find the Wyoming LLC. They rush to court to try and seize the assets inside that LLC bank account.
They are coming straight for the gold.
As soon as that severe legal threat officially appears, what we legally term an event of duress, the trust structure instantly activates its defense protocols. You, as the manager of the LLC, are immediately fired.
Wait, I fire myself.
The offshore trustee steps in and formally removes you as manager. Or, better yet, the LLC's operating agreement triggers an automatic instant removal the second a subpoena is served.
Oh, wow.
Suddenly, that LLC is no longer legally managed by you in the United States. It is now fully managed by the foreign trustee down in the Cook Islands.
The operational control literally shifts offshore in the blink of an eye.
Instantly. The entire legal bridge back to the U.S. is effectively burned to the ground. The creditor desperately reaches for the LLC, but the control panel has been legally teleported to the other side of the planet.
That is incredible. But what about the physical gold itself?
That is the third and final corner of the triangle. The physical gold isn't sitting in a Wyoming bank vault. It is sitting securely in a private Freeport vault in Singapore, or maybe Zurich.
So the U.S. judge has strict jurisdiction over me, the former manager, but I legally have zero control anymore. He technically has jurisdiction over the LLC because it's in Wyoming, but the LLC is now managed by a foreigner who will laugh at his subpoena. And the physical assets are locked in a vault halfway across the world that he cannot possibly unlock.
You have beautifully summarized the entire strategy. You have effectively severed every single limb the U.S. legal system usually aggressively grabs onto.
It's brilliant.
Legal ownership is firmly in the Cook Islands. Operational control was briefly in your hands but is now safe offshore. And the physical assets are sitting in Singapore. It is a highly sophisticated shell game, but the shells are constructed out of solid titanium.
That is undeniably sophisticated. I can totally see why the smart money pays to do this. It is just layers upon defensive layers. But look, I have a very practical, everyday question.
Sure.
I'm a retail investor at heart. I really like liquidity. I firmly believe in having cash available. I like knowing that if I desperately need cash to buy a new house, to pay for an unexpected medical emergency, or to send my kid to a nice college, I can instantly access it.
Right. Liquidity is essential.
Well, if my life savings is tied up in gold, locked in a heavy vault in Singapore, legally owned by a trust down in the Cook Islands, how do I actually buy groceries? How do I live my life?
This brings us to the final, most elegant piece of the puzzle today, the liquidity problem. And I promise you, the sophisticated solution to this problem creates yet another massive tax loophole.
I am all ears. Lay the loophole on me.
If you own physical gold personally, outside of a trust, and the price skyrockets, and you decide to sell some to get cash, what happens?
I pay capital gains tax to the IRS. And for gold, it is exceptionally high, right? It isn't the normal 15 or 20% rate for stocks.
You are absolutely correct. Physical gold is specifically classified as a collectible by the Internal Revenue Code. It is aggressively taxed at a flat 28%. Plus, you potentially have state income taxes stacked on top of that.
So I lose a third of my profit.
Exactly. If your gold significantly appreciates and you sell it to get liquidity, you are instantly losing roughly a third of your hard-earned profit to the government.
That physically hurts to think about. So if the trust decides to sell the gold instead of me, does the trust still have to pay that 28% tax?
Yes. The trust would technically have to pay the tax on the realized gain. So the simple answer is, we never, ever sell the gold.
Wait, if we never sell the asset, how do we possibly get the cash to live on?
We go straight to the billionaire playbook. We execute the buy, borrow, die strategy. The trust simply uses the gold sitting in the vault as rock-solid collateral.
Collateral for a loan. I see where this is going.
Exactly. The trust officially approaches a private international lender or a specialized private bank. They say, look, we have $5 million in pristine physical gold sitting securely in this Singapore vault. We want to open a flexible line of credit for $3 million.
Fully secured by the precious metal.
Fully secured by the metal.
Oh,
the bank
okay.
happily gives the trust the $3 million in cash. The trust then legally distributes that cash directly to you, the primary beneficiary.
Let me stop you. Is that massive cash distribution considered taxable income by the IRS?
No, because it is legally classified as loan proceeds. Borrowed money is never considered taxable income. It is categorized as debt, and debt is completely tax-free.
Debt is tax-free. I absolutely love that sentence. It feels like a cheat code.
It is the absolute cornerstone of modern billionaire finance. You receive the $3 million in liquid cash. You spend it on whatever you want, houses, cars, medical bills. You pay exactly zero income tax on it.
Meanwhile, the gold...
Meanwhile, the physical gold stays safely locked in the vault. Ideally, the price of gold continues to appreciate over the long term, say conservative estimates 5% or 8% a year. The interest rate on that secured loan might only be 4% or 5%.
So the natural appreciation of the gold is literally paying for the ongoing cost of a loan itself.
Exactly. It's a beautiful financial arbitrage. Your core asset is reliably growing faster than the debt is accumulating. You're actively stripping all the needed liquidity out of the asset to fund your lifestyle without ever actually selling it.
That is genius.
Without ever triggering a 28% capital gains tax. And crucially, without ever triggering the 40% estate tax.
But what happens when the lap ends? What happens when I finally die?
When you die, the loan balance is still there on the books. The physical gold is still securely there in the vault. The trust simply continues its existence. Your children step up as the new beneficiaries.
And the debt?
They can choose to slowly pay off the loan with outside funds. They can easily refinance it with the bank, or they can simply keep the exact same game going indefinitely. The ultimate point is, you have successfully lived your entire life utilizing the massive liquidity of your wealth, but you have never technically realized a taxable gain.
Incredible.
You never own the asset in a way that allows the federal government to legally step in and take their massive cut.
Buy, borrow, die. But in this specific legal architecture, the trust itself doesn't even die. So it is really buy, borrow, live forever.
That is the ultimate essence of the dynasty model.
Wow. Okay. I really have to say, my entire perspective has drastically shifted over the last hour. At the very beginning of this briefing, I was intensely thinking tax evasion. I was thinking this was all incredibly shady.
And now,
Now, I am strictly thinking about survival.
that is exactly the shift we aim for.
I am thinking hard about that looming January 2026 date. I am thinking about the red target painted on my back right now. It is genuinely terrifying to realize how hopelessly exposed the average hardworking person is simply by following the standard financial rules. We're down here playing simple checkers, and the tax system is clearly designed for three-dimensional chess.
The system is structurally designed to efficiently harvest the accumulated wealth of the upper middle class. The ultra-wealthy deeply understand that the tax code isn't just a set of punishments. It is a highly complex series of legal incentives and disincentives.
Right.
If you take the time to deeply understand the code, the actual source code of the matrix, you can safely navigate right through it. If you blindly ignore it, you simply get processed by it.
Processed by it. I really do not want my family's legacy to be processed.
Then you absolutely have to take decisive action.
Okay.
But I urgently want to issue a very stark warning here as we begin to wrap up this briefing.
Please do. What is the terrible catch here? Because in finance, there is always a catch.
The massive catch is administrative complexity and absolute strict compliance.
Huh.
This is absolutely not a weekend DIY project.
I wasn't going to try.
Do not go online late at night and blindly download a cheap Cook Islands Trust template for $500.
I assume the IRS has incredibly strict reporting requirements if you try to pull this off.
Extremely strict. Brutally strict. There are mandatory federal forms like the FBAR, the Foreign Bank and Financial Accounts Report. There are complex SATIA forms.
Yeah.
You legally have to accurately file Form 3520 and Form 3520A every single calendar year to officially tell the IRS, yes, I proudly have a foreign trust.
Full transparency.
You have to explicitly tell the IRS exactly what you are doing.
And what happens if you accidentally mess up the complex paperwork? Or your cheap accountant forgets a form?
If you simply fail to file these specific forms, or if you accidentally file them incorrectly, the federal penalties are downright draconian.
How bad?
We are talking automatic civil penalties that can rapidly reach 35% to 50% of the total account value.
A 50% penalty. Wait, that entirely defeats the whole purpose of setting it up. That is mathematically worse than the 40% estate tax.
Exactly. That is precisely why you absolutely cannot cut corners on the foundation. This elite strategy requires flawless professional legal architecture. You desperately need a top-tier specialized asset protection attorney.
Thanks, S.
You firmly need a specialized CPA who ductily understands international tax compliance and treaty law. It is undeniably expensive to set up correctly. It might cost you $20,000, $30,000, maybe even $50,000 to completely build the fortress right.
50 grand. That sounds like a whole lot of money up front.
It definitely is a lot of money, but I want you to strictly compare that upfront cost to the inevitable cost of doing absolutely nothing.
Let's do the math again.
If you have a $5 million estate sitting violently exposed above the 2026 exemption limit, and the government automatically takes their 40% cut, that is $2 million instantly gone from your family forever.
So mathematically, I pay $50,000 once to safely save $2 million.
That is a true return on investment.
Yeah.
That is exactly how the smart money does the math at the kitchen table. The middle class looks at the scary upfront cost of the elite attorney and immediately says, oh, that's way too expensive, I'll just risk it.
Right.
The wealthy look at the massive looming cost of the estate tax and confidently say, that attorney is the biggest bargain of my life.
That is the complete mindset shift right there in a nutshell.
It absolutely is. So my final provocative thought for you and for the listener today is simply this. I want you to go home tonight and really look at your hard-earned assets. Look at your physical gold stack. Look at the paper deeds to your real estate. Look closely at the titles, whose name is physically written on them. If your personal name is legally on the gold, the United States government's name is legally written on your estate.
Wow. That is definitely going to stick with me for a long time.
Remember the core mantra we discussed today. Own absolutely nothing. legally control everything. That is the only proven historical way to ensure your family's legacy survives the brutal 2026 wealth filter.
Own nothing, control everything. We really went deep today. We completely journeyed from extreme skepticism to actually understanding the hidden machinery of the ultra-wealthy. It is not about illegally hiding in the dark. It is about expertly engineering your future in the light.
Exactly right.
This has been a massive, terrifying eye-opener for me, and I sincerely hope it was for you listening at home as well. This isn't just interesting financial theory. This is the actual operational playbook. Thanks for taking us so thoroughly through these highly classified files today.
It was my absolute pleasure. Just remember, the future always belongs to those who actively prepare for it.
Well said. That is it for today's deep dive. We will catch you all on the next one. Stay safe out there, and seriously, go check your liability exposure.